I think if you're someone that's studied and gone deep down the rabbit hole of how inflation works, it makes a lot of sense. I think for most of us, it's a little hard to grasp why giving money, buying that up, suddenly creates inflation. Can you try to just at a high level explain that, how that works?
Absolutely. So I'll back it up to 2008 when they did QE, and why, myself included initially, I thought there might be inflation. Then you start reading about the differences of what they did in '08 versus what they did in 2020, and why there wasn't that much CPI inflation then and why there has been this time. Back then, when the Fed buys an asset, it's not like the Fed has money saved up. The Fed is creating that money out of thin air. And so when they then go and buy these assets, in '08, these were assets that and a lot of times had fallen in price. And so they're basically writing an asset back up and they're creating asset inflation. And then there's a bleed off effect of, hey, my portfolio's worth more, so I'm going to spend more here or whatever. And that was kind of how '08 worked. But it's why you didn't have this broad scale CPI inflation that we've seen in the aftermath of COVID. If you fast forward 12 years to 2020 reaction, what we had was the government hands everybody money, and then offsetting that, they raise money in theory, they raise money in the markets by going around and borrowing that money. The theory of it, as you think about it in your head, well, the government just spent it, and so the government then goes to everybody that saved money, and those savers buy the bonds from the government, and there's no net change in the money supply. And that's how I think a lot of people think it works. The reality is the government spends the money, hands it out, and then they issue those bonds, but there aren't enough buyers for all these bonds. And so what happens is, again, the Fed creates money out of thin air to buy these bonds. Well, if the Fed creates money out of thin air, hands it to the government, and then the government hands it to the people, what we're really having happen is the money supply is increasing. It's just a case of more money chasing the same or fewer goods. In the case of what we've seen in the last year, due to supply chain disruptions, due to some corporations, I was hearing this last summer or earlier this year, was something that corporations learned during COVID when they had to shut down these supply chains. They might have been running 6 production lines and they went to 3. And what they found was, let's just go back to 4 and raise prices 20%, and our returns on capital for our shareholders will be vastly greater by doing that than if we just bring all 6 lines back. And so there's been a lot of that type of behavior where the corporate systems are so good, they can run those analytics now, and they know exactly how to profit maximize along some curve of price and volume. And I think in addition to the money supply increases, the supply chain disruptions, there's probably been a lot of profit, return on capital maximization decisions made across corporate America and across the world over the last 12 to 18 months.
Yeah, which is hard to fault. Obviously, it's not great, but it's hard to...
That's what happens when you have concentrated industries too, right? When you're very fragmented industries, but we've been moving towards much more, I wouldn't say monopolistic, some areas monopolistic, but much more monopsonistic, I don't know, oligopolistic, how's that? That's one. Much fewer bigger competitors that, they're not coordinating, but maybe they gave each other a wink, wink, nod, nod, and everybody gets a little richer for them, so...